fresh U.S. manufacturing numbers took a, quote, sharp turn for the worse last month, now dropping at a 5.3% annualized rate. That matches last year's lows, and both are the worst since the 2008 crisis and, of course, the COVID lockdowns. In fact, this now marks the 8th straight month of contraction in manufacturing, also the worst since 2008. In the latest numbers, both production and employment declined, while new orders, which is a canary in the coal mine in manufacturing, collapsed. Surprisingly, even consumer goods are now contractionary. So manufacturers reported consumers pulling back because of 1, rising cost of living, 2, higher interest rates, meaning higher debt payments, and 3, growing concerns about the economy, as in consumers are afraid of losing their jobs. Finally, pricing power flopped in the new survey, which normally would be cause for celebration in this inflationary age, but in this case, it is companies purging inventory, selling it at whatever price they can get in preparation for a collapse in sales. In fact, sliding manufacturing is now a worldwide phenomenon as contraction in the US and Europe spreads to Asian exporters. Europe's most recent PMI came in even worse than the US, while Europe's year-on-year industrial production is at a 4% drop. Both also the worst since both 2008 and the lockdowns. Of all of the major countries at this point, only China is in positive territory, and just barely. This global manufacturing crunch is hitting global commodity prices, which are now plunging despite ongoing worldwide inflation. So normally inflation should boost commodity prices because they're hard assets, but recession is now overwhelming that. As a whole, commodities are down 12% on the year, while industrial commodities, which are more sensitive to recession, are down 14%. Oil, which is very sensitive to recession, is down 39%. So what is next? I'd expect a continued drop in goods prices as companies liquidate inventory while workers give up on raises for fear of finding another job. The next domino to fall will be services, as cost of living, debt, and jobs all hit demand for everything from haircuts to construction. If that too falls, at that point, expect the long-promised drop in core inflation, but not because they fixed inflation, rather because they finally killed the economy. Biden's handlers will no doubt take a victory lap, either because they don't know or they don't care that inflation is being squeezed out of the American people and paid in blood. After trillions in money printing to finance government deficits, there are fundamentally only 2 ways to fix an inflation: shrink the money or crash the real economy. While money supply is now contracting at the worst rate since the 30s, I did a video on this last month, that is still only a tenth of the 40% increase in the money supply during lockdowns, leaving the other 9/10 of money printing to beat out of the American consumer. We are seeing what could be the largest engineered recession in a generation, all to hide the obscene money printing it took to bribe voters into lockdowns. Our leaders are still in denial, but businesses and increasingly consumers are getting ready for a major storm. Okay, we'll be watching. See you next time.